you're an all-star. Get your game on, go play. Hey now, you're a rock star. Get the show on.
And we are back this Saturday afternoon, a Big Money, Big Daddy show. This is Mark Conley. Dale Pieper is right here by my side, and we are out here battling the front in the investment world to try to teach our investors that there is a right way to invest. You can be successful. There's no guarantees in this life, of course, but there are tried and true scientific ways to invest as compared to listening to the media hype and everything that's going on out there where they're trying to get emotional movements in your portfolios. We're trying to bring you down, use logic, use math and science, and we feel like emotion can actually be your friend once you have the right facts. You have a logical plan, not just money in the market, but you've got a financial plan. You know how much money should be in the market, how much should not be in the market. You know that you're saving enough money for retirement, and you understand the cash flow situation you're in, how to increase cash. Once you know all that, that's going to put you in a powerful position to then behave properly, because you don't have to be a knee jerk to every single thing that happens out there in the marketplace. And you know when to buy, you know when to sell, and that's what we're about. So segment one, we were covering media hype, how to start to recognize it for what it is, to move away from that into math and science. So that's where we started to cover ways that you can increase return and reduce risk by having the right mix of assets, which controls 95% of your overall return, by the way, as we pointed out, has been discovered by Nobel Prize-winning economists. And we also started to say, well, then, if stock picking and market timing, if those just don't work in the long run, or no one's proven their ability to be able to do it, in the long run, or no one that I've seen. I guess maybe there is someone who's pulled it off, but I don't know where they are. But then what can you do? Well, there are premium returns that math and science show would be there, and that would be in the distressed companies. That would be in the smaller size companies. So, an example of that might be Buffalo Wild Wings as compared to your large companies like, Exxon and Apple. And so let's kind of put things to the test. I mean, what would we expect to have happened over, we'll do, I've got a 23-year study here. Well, we'd expect markets to be volatile. Okay. Well, I think, we could say that. We don't believe that anybody would be able to consistently and predictably beat the market. Okay. Find someone that over that time frame has beaten the market, and it will be an itty bitty number, if there even is anyone. I don't know, and I definitely wouldn't recommend you go then and take your life savings and put it with them, thinking they're going to do it the next 23 years. But that is what we've seen. We would expect that the stock market would have better returns than the fixed income market if our theories of science hold true. We would expect that small companies outperform large companies. And we would expect that value or distressed companies would outperform growth over that time. And so that's the hypothesis. So let's put it to the test. We also would expect that by diversifying and having assets that weren't 100% correlated would give us improvements to the portfolio and in different asset classes. So if we run these numbers, and we look at the entire market as measured by the CRSP 1 through 10, the actual return of the market over that period of time, 92 to 2014, has been above 9% per year, 9.66%. T-bills, so that's considered the safest investment over that time frame, was 2.76. So you almost got 7% return by believing that the capital markets and that capitalism itself would be victorious over this time. 6.9%. So when I look at the theory number one, how about we look at that on a cumulative total return? Well, the stock market over that time frame was 733%, T-bills 86%, for added value, extra premium of 646%. I think the stock market wins.
Yeah, those are incredible numbers when you see them. And you hear them.
Yeah, I mean, if you just look, if it was 100 over that same time frame, $100,000 in the market, as still measured by that CRISP index 1 through 10, would have grown to 833,000, whereas 1 month T-bills, your 100,000, it would have grown. You'd have 186,000.
Probably didn't keep up with inflation.
Yeah,
maybe barely.
So, next one we're going to test. What about small companies? Well, over this time frame, as measured by the dimensional U.S. microcap index, they returned right at 14%. The S&P 500 index returned 9.38. That is a small premium. Well, actually, I should say it's a pretty large premium. But for the small company category, that premium is 4.63%. Guess what? It worked. What is that cumulatively? Well, we had 1,941% return with small companies. S&P 500 was pretty good, though, 685%. But that does give you an extra 1,255%, or another way to think about it, 100,000 in small companies would have grown to $2 million, or your 100,000 in the S&P 500 index would have grown to 785,000. Now, when we give those numbers, that's just what happened, okay? I'm not predicting what will happen in the future. I'm merely saying when we put our theory to the test, that's what we find. And I'm just using this time frame for today's show, but we can run it over whatever time frame you want. Just give us an email, and we'll be happy to set up a time. All you need to do for us to get in touch with each other is just text the keyword daddy to 72727. Text daddy to 72727. All right, what do we got left here? We got value.
Yeah, so if we look at annualized rate of return for U.S. large value over the same period of time that we're looking at from 92 to 2014, that's averaged 11.86%. Then you look at the S&P 500, so that's the large growth category or the largest 500 companies in the United States. That annualized return was 9.38%. And so you've got the value premium of 2.48% over that time period.
And that value is measured by the dimensional U.S. large value index.
Thank you very much. So then you've got the total return for U.S. large value over that time period is 1,217%. And then you've got the S&P 685, almost 686%. And then the premium over that time period, the value premium that you would have earned was 531%. So these numbers are they're pretty stunning. And the thing that gets me is when you look at just the annualized numbers. I mean, you look like small, it's 4.63%. Just overall, and then you look at value, it's 2%. That's not just 4% for that whole. I mean, it's 4% per year. So you start talking about, if you've got hundreds of thousands of dollars sitting inside of a portfolio and you're getting an extra 4%, 2%, 6% on an annualized basis, that's a pretty big difference in lifestyle when you get to retirement.
Yeah, it really is. And another way to look at those premiums, I know we're doing the study here just in this time frame, but if I actually go all the way back to 1926 through 2014, and I look at 20-year rolling time period, so that's like a study of 828 different time frames, small actually outperform large 82% of the time. And look, at the end of the day, if investing is putting yourself in the most powerful position to have the best chance for success, I mean, anything that's got 82%, I mean, I'm going that direction. I get it. That means, 18% of the time that would have been the wrong move if you happen to be in that 20-year time frame. But I would take those odds all day long over the gut feeling of some money manager trying to guess when to move here and when to move there, especially considering the data on that, according to S&P 500, shows they're only able to pull things off, roughly 20% of the time. If I look at value over that same period of time, it's 96% of the time. So like in our example, value actually was giving wasn't doing as well as stocks over fixed and small over large, but value's actually shown the highest consistency that over different time frames you always get to truly see that premium come true in your portfolios. So, there's we got some studies here. We don't want to go over too many of the numbers, but we can go over, looking at them together. I mean, that one might be worth doing. I mean, if we looked at
small value.
Yeah, if you look at adding small and value together, let's see what that is. Let's see. Looking here at these numbers, it looks like the return over that time was roughly a little above 15%, and 500 largest U.S. companies was a little over 9%. So the small value premium was almost 6% per year. It's wow.
Yeah, it's crazy. And the cumulative premium over that same period of time for small value was over 2,000%. So the numbers are just amazing when you start looking at it.
Yeah, I just ran this. So $100,000 over that time frame. We're still doing the 92 to 2014. In the dimensional U.S. small cap value index grew to $2.8 million. Do not expect your portfolio to go from 100,000 to 2.8 million, even though that's what it actually did.
Yeah,
but
it's 4 times as much. If you would have put it in the S&P 500, it got you 785.
Yeah. It's it's just nuts, but this stuff works. And to me, that's exciting. When you have a way to invest that can give you the opportunity for things to be more consistent. I mean, that's what makes me excited. Forget all the hype, because those are just predictions and they may or may not work. But I do think that also in all this, science can tell you what doesn't work. Okay. I mean, let's look at all the stories that we've heard over the past years. I mean, if you remember when commodities were on a run not too long ago, or gold, gosh, everybody knows, buy the gold, or real estate, or, right now we've seen past couple of years, the S&P 500 index actually was the top performing asset class. So now everybody says, oh, you can buy that cheap, just buy that, and that's all you should do. Well, we just gave you numbers showing, sure, you could do that, and, all the power to you. You get some results. They were positive, but if you want to, I think that our listeners and our clients deserve the best possible returns for the risk level they're comfortable with. So that's, they need to understand that there are ways to do it. I mean, just talking about, if the S&P 500 against that small value, that's that 2.8 million versus 785. I mean, you lost. If you would have just went with the S&P 500 because it was cheap. Okay, if I add small value, I got cost. Why not just go the cheapest? Well, yeah, you got the cheapest. Name something else in life where the cheapest is always the best. Okay. I mean, technology, everybody was saying, if you look in the late 90s, technology had this huge boom, and, small cap value. Oh, boring small cap value. That's old news. Free market portfolio theory, math, science. That's old news. It's a new era. Everybody went to technology. Well, if I go from 92 to 2014, your 100,000 in technology as measured by the NASDAQ index, you got a little under 950,000 compared to your 2.8 million. Which one do you choose? What are some other ones that we saw in the past? Real estate. That was a good one. So when you had the real estate boom, I look at the same 100,000 over that time frame. Real estate would have grown from 100,000 to 1.2 million. Made you money. Not denying that. However, again, why not? If you look at you're looking at about the same risk level with the small cap value, and I don't need to repeat the numbers, because you get the point. You got to remember, when you buy these things for the sake of diversification, you've got to take something else out of the portfolio that has a better risk and return ratio associated with it. I mean, commodities, 100,000 over the last, from 92 to 2014, only grew to 222,000. I mean, and people add that all the time. Well, it's a diversifier. Well, so is roulette, as I said in the last segment. Roulette is not have anything to do with the stock market. Your returns in roulette will be entirely separate, uncorrelated to the stock market. Does that mean it's a good investment to add to your portfolio? I think not. I think the science is there. I think the proof is there. And that brings us to the bop, bang, boom, hard truth minute that only a good Big Daddy would tell you. Media and politicians are full of hype. This will not help your performance. It will probably hurt. Average recovery after the fact is only 111 days for a correction to go to pre-correction levels. So why are we stressing out about this if you're a long-term investor? You want premium returns and a way to lower risk? Well, then you need to make sure you've got international and you've got value and distressed and small companies in your portfolio. Use science, people, not hype. That's how you should build your portfolios. You can put the hypothesis of free market portfolio theory to the test, and you'll see the truth yourself.
So that wraps up today's show. If you do want to get on the invite list for our coaching event coming up in June, please text the word daddy to 72727. Text the word daddy to 72727.
Big money, big daddy.
I've had enough of scheming and messing around with jerks. My car is parked outside, I'm afraid it doesn't work. I'm looking for a partner, someone who gets things fixed. Ask yourself this question, do you want to be rich? I've got the brains, you've got the looks. Let's make lots of money. You've got the brawn, I've got the brain. Let's make lots of money. You got the brawn, you got the brain. You want money.
Hypothetical examples discussed are not intended to suggest a course of action or represent the performance of any product or security. All investments contain risk and may lose value. Past performance is not a guarantee of future results. Diversification does not guarantee profit or protect against market loss. Investing in foreign securities may involve heightened risk, including currency fluctuations, less liquid trading markets, greater price volatility, political and economic instability, less publicly available information, and changes in tax or currency laws. Such risk may be enhanced in the emerging markets. The S&P 500 index is generally considered representative of the stock market as a whole. It, however, focuses on the large cap segment of the U.S. market. Indexes are unmanaged and you cannot invest directly in an index. Wealth Design Group does not give tax or legal advice. Anything mentioned in the show related to these items is not advice, and you must check with your CPA or attorney prior to taking action. Securities products and advisory services